Well, Nick, we are back for episode 2 in this series on private equity investment in pest control, lawn care, and landscape. And, today what I really wanted to talk about is the investment process. So how private equity firms actually come up with an investment thesis, how they go out and source deals. And I think this is actually it's important for entrepreneurs out there who are actually looking to make investments, because following what private equity does is a great way to learn. And it's a great way to also get businesses on the cheap, as those guys are really focused on proprietary and unshopped deal flow. And we'll get into that a little bit. But let's talk a little bit about investment theses and how these funds go about doing what they do.
Yeah, let's do that. It's a good topic, because it's not as if these private equity firms are myopic or generally unresearched on how they're going about finding new opportunities. They do a ton of due diligence before they even decide to enter an industry. Let me give you an example. So they may start a research project among some of the principals or partners in the private equity advisory firm to really go out and research multiple industries. It could be residential and commercial services. It could be, healthcare information technology. It could be various other businesses, waste management, et cetera, et cetera. And so when they do that, they'll do deep research projects on each of those verticals or industries to decide where they want to start to deploy capital in the form of a platform to start off, okay? And so the nature of this research really typically starts on assessing the overall market opportunity. This could be looking at the total addressable market, or TAM, as it's often called in the industry, in the investment industry, to really understand, okay, how big is the lawn services market? How big is the pest control market, which is around $12 billion and growing at about 6%, which is also a variable that they're going to want to understand, because the last thing a private equity firm will want to do would be to go into an industry that is too small for their pool of capital and investment objectives, and also potentially go into an industry that doesn't have that strong underlying growth over multiple cycles, or what's often referred to as secular growth, the ability to grow through cycles at a rate that's likely to be acceptable for that private equity firm. What do you see, Paul, when you think about how these private equity firms are analyzing the entry into a particular industry?
Yeah, I think that's right. I mean, look, when you look at market size or total addressable market, to give you a prime example of this, we sold a business called VDCI some years ago, and Rentokil bought it. It was actually a private equity backed business. At the time, it was doing roughly $50 million in revenue, and it did vector control, which is basically municipal mosquito control, as well as lake management. And I remember, man, this was 5, 6, 7 years ago, when we were taking the business out to market. We brought it to private equity as well as strategic acquirers. And when the private equity firms looked at it, they said, well, wait a second, if pest control in North America is a $12 or $13 billion industry, lake management, even though this is the largest lake management, the lake management business that they owned was called Solitude, which was underneath VDCI. They said, wow, this is a big lake management business, but in the whole scheme of things, what is this, a $500 million or billion-dollar industry in North America? There's not a tremendous amount of runway for us there. That makes more sense for a strategic acquirer that can grow inch by inch and cross-sell and so on and so forth. So total addressable market's important. I think you raised another key point is these private equity funds are looking to invest in industries that are growing, right? Industries that are, and typically industries that are growing at a rate faster than GDP.
Correct.
If you look at the pest control industry, and you and I have talked about this quite a bit, I think we chatted about this on the Buzz the other day, which is, there's a lot of tailwinds in the pest control space. The folks our age are not doing pest control. We don't even know how to do it, for example. No one wants to go out and fertilize their lawn. You don't want to be out in 90-degree days spreading fertilizer. Our parents did that sort of stuff all day long. I mean, my father did his own lawn. He killed his own bugs. He never had, the only time he ever hired anyone to do anything, I remember termites. We hired Orkin. We had a termite problem. It was going to eat our house down. That's a serious issue, and it's something he wasn't going to solve on his own. But for the most part, killing ants in the kitchen, the Orkin man wasn't coming for that. So I think.
So are you telling me that he didn't recruit you successfully?
No, well, he knows better. I've never done a hard day's work in my life. I can't do manual labor. What are you talking about? So now, yeah, he knew better. But it's true. Like he did everything, and now we don't do anything at all. So I think fundamentally on the demographic side, that of course is a nice tailwind. So I agree with you.
It's a great point though, because that is the type of analysis that private equity firms do, is thinking about not only the surface level growth of a particular industry, but what are the underlying qualitative factors that are leading to that growth? And then also understanding, most importantly, is that sustainable? So do we think that's an enduring trend that homeowners are going to continue to outsource the services that they need in order to maintain that home or not? And I would say, generations are continuing to get, let's call it softer and softer, and not wanting to spend their time doing those types of home duties. And so they're outsourcing it. So that's likely to be a sustainable trend, and that's an analysis that private equity firms would do at the forefront of making any investments.
Yeah, I agree with you. That's at that very kind of high level macro industry type analysis. When I, here in our practice, we get an ungodly amount of calls from private equity firms looking to get into a variety of resi and commercial services. Because of our historical specialization in pest, lawn, and landscape, we get 1 million of those calls. They call and they ask a lot of questions about growth rates and so on and so forth, but very quickly they get into the next phase, which is market fragmentation, right? And understanding because, over the last 15 years, we've gotten back to the roll-up model that existed very heavily in the 1990s, and living in this era of very suppressed yields or otherwise low interest rates that favors roll-ups. And what I mean by a roll-up is effectively buying 50 separate companies and putting them together in some way, shape, or form. And so industry fragmentation is very important to private equity firms, because if they can go out and buy a platform business, the next question is, well, how many add-on acquisitions can we do? And I deal with this now every single day, where if you look at, let's take pest control, for example. You might have a great potential platform doing $20 million in revenue in the middle of the United States. But when you look around that $20 million platform, there are not that many potential add-on acquisitions. Whereas you might go to Fredericksburg, Virginia, for example, have a $20 million platform there, and within a 200-mile radius, you literally have 1,000 companies that these guys can buy. Private equity investors going to look at those two potential platforms very, very differently. Just due to the runway of being able to acquire. And it's not just private equity firms. I mean, strategics look at it the same way. I mean, I once talked on The Buzz about anticimex. We were selling a business in the Midwest. It was, I can't remember how big it was. It was between 15 and 20 million in revenue. Anticimex, being a private equity backed portfolio company, looked at that business and said, there's not enough runway here in the Midwest for us to blend down our entry multiple and do a bunch of add-on acquisitions. So it ultimately went to a strategic, because they're far less sensitive to that than private equity firms. So location, jurisdiction, and potential add-on acquisition opportunities is a very important consideration from a private equity perspective. What else goes into the thesis as these guys develop it?
Yeah. Before I move on to the thesis, one thing that comes to mind in what you were discussing is thinking about the business model of route-based businesses such as lawn, landscaping, and pest control.
Yep.
And this is actually the next phase of what the private equity firms would do as well. But in thinking about add-on acquisitions and who to buy as the initial platform, that can be particularly important when route density is such a driver of profitability. So if you have a lot of add-on acquisitions that the platform can make, you can fill in route density. Okay. And when you fill in route density, as you know, and as all the operators know, that's likely to be higher margin business. Not likely, it's going to be higher margin business than if you're going and spraying acquisitions in jurisdictions that are further flung out of your core area. So I think that's actually unique and actually even emphasizes more how important it is to have add-on acquisitions in route-based businesses. Would you agree with that?
I would agree 100%. In fact, let me show a graphic here where and we do this sort of analysis all the time. And you can see on the graph here as market share. So this looks at a particular market in a route-based residential services business. As market share increases, you can see the increase in operating margin, which is substantial. As market share goes up, that operating margin goes up very, very quickly. So your point is exactly right and head on, that due to that whole density effect and the ability to expand gross margins. Basically, guys, at the end of the day, you're sending a truck out into the field. If you can service 10 homes instead of 5, or 20 homes instead of 10 in one day by increasing the density, you've dramatically increased your gross margin as well as your operating margins. And you can see that right here, clear as day in the chart.
Yeah. And look, you're in the catbird seat here because you have 70+% market share, if not more, of pest control, seller, mergers and acquisition activity. And so you have this data, which really arms you with that information to be able to go to buyers and say, look, this is going to increase your route density, which makes it a much more profitable acquisition, with greater cost synergies and route synergies. And so having that information, I would imagine, maybe I'm wrong, but I would imagine that allows you to have a different conversation with the buyer about the value of that business you're selling.
I'm glad that you brought that point up, Nick, because when I look at a lot of materials that sellers will put out into the market or other advisors, the majority of the discussion is around synergies on the cost side, right? So somebody will put together a book or a sim and say, hey, here are the cost synergies rentokil can get by acquiring this particular business. To your point, what we're able to do is that's basic arithmetic, quite frankly. Where things get really interesting is on the revenue enhancements and the density, and all of this takes place above the gross profit line. So I can basically say, hey, this 10 million in revenue from this target in this footprint, by the way, private equity firm A, if we add this into your portfolio, not only are you adding, $2 million on the bottom line, you got an additional $1 million in SG&A cost savings, but you got another $1.5 million in increased density from combining this footprint. And so we've got the data to be able to do the math. So it's very easy for me to follow along in the background and understand whether or not, a lawn care acquirer is actually really providing the value there, or a pest control acquirer is really realizing the revenue enhancements and synergies related to density that they're going to get. I appreciate you bringing that up because it's oftentimes something that's not talked about.
Yeah, and it's something that frankly buyers likely try to take advantage of.
Of course.
Because there is so much low-hanging fruit that's not on the surface, though, those that aren't paying attention to those details.
It's not.
So this point really leads me to the next part of doing due diligence on an investment opportunity for a private equity fund, which is actually just understanding the core business model and economic model of the businesses that they're actually acquiring. Okay. So for route-based businesses and residential services, such as lawn, landscaping, and pest control, especially for maintenance and pest control, really a core tenet is that recurring revenue. So that's clearly a feature of a business that's attractive to private equity. And one reason is that private equity firms, one thing we haven't discussed is that they typically have a substantial amount of debt that they place on these businesses in order to lower their cost of equity and use financing to enhance their returns. Okay. So if you're doing that with a business that doesn't have recurring revenue, or a business that has very cyclical revenue. So as the economy ebbs and flows, their revenues go up and down. That makes it much harder to add that debt or leverage to those investments. Whereas these residential services have recurring revenue, and that revenue is typically fairly stable.
I do want to talk about this a little bit more when we get to the section on the risks and benefits of partnering with private equity. But since you bring it up, I'd like to chat about it right now for a second. You talked about leverage. And one of the things that private equity firms think about, even as they're developing their investment thesis, is how are we going to be able to spruce returns by applying leverage? And you're right, the recurring revenue nature of pest control and lawn care, for example, allows private equity firms to put slightly higher levels of leverage. And when we talk about leverage, we just mean debt. And it's an important function of what private equity firms do. I mean, historically, Nick, I guess if you think back to the bad reputation of the LBO shops of the 1980s, right? It was going out, borrowing a ton of money. Debt to EBITDA was 6, 7, 8, 9, sometimes 10 times. They would put a ton of debt on these things, effectively break up companies, so on and so forth. And I think the private equity industry got a bad name from financial engineering. Now, that still exists. But I think that's far less of what goes on in private equity today than it ever has been. Would you agree with that?
Generally, I would agree. I also think that there's been some very good brand positioning on the part of private equity, as they used to be called LBO shops, not private equity shops.
Right.
And instead of junk bonds, now they're called
high yield
investment grade bonds or high yield bonds, right? Yes. So they've done a great job to our friends at private equity. Kudos on your positioning. I applaud you. But in general, I think some of the early episodes of the LBO industry or the private equity industry was really more hostile transactions with bigger businesses as well. And oftentimes, LBO shops were actually trying to take over or acquire public companies in a hostile fashion by using a lot of leverage or debt financing. Okay. Yep. So now private equity firms are actually private businesses' best friends. And I like to say, look, private equity firms and the institutional investors that are financing them are making tons of blue collar folks rich, which I'm all for.
Absolutely. So Nick, to get back to the thesis here, so private equity firms will obviously look at things from a macro level perspective. Then we'll look at demographics, total addressable market, so on and so forth. But, based on the discussions you're having with private equity firms, why have they zeroed in on resi services?
So I think they've really zeroed in on resi services, first of all, because it's a substantial market in the overall market size. And then you have these qualitative factors. They really provide a line of sight to having good underlying growth over the long term, well in excess of GDP, that can also be augmented with pricing power. And when you think about pricing power, that really leads into this recurring nature of the revenue that's coming from residential services such as pest control and lawn maintenance. In that, you have a subscription-based business model that provides recurring revenue that also doesn't exhibit a lot of cyclicality. When you add that up and combine it with a low capital intensity and high gross profit margins, it leads to a business model and an economic model of these businesses that's well suited for private equity firms' investment, particularly when you think about the debt a private equity firm will often use to augment their investment returns.
So now that the private equity firm has zeroed in on, for example, pest control as a industry to go after, what's the next step here?
I think really the next step is market and platform identification. So really thinking about within this broad landscape, this macro landscape of pest control, where in the country should they enter and who are the targets that they could acquire first or as a platform in order to then expand on with add-on acquisitions. What are you seeing, Paul, in that?
Yeah, that's exactly right. I mean, usually, once the investment committee has had discussions as to where it wants to be, let's say pest control is this segment, the private equity firm wants to go out after, the first thing they do is they call guys like me. I mean, I get every single call there is. Every single private equity firm that it doesn't matter if they're in Sierra Leone, in Germany, in the United States, I get the call. They track us down here at Potomac to talk about the market, talk about the fragmentation, of course, talk about valuation, so on and so forth. But then you're right. The next step is zeroing in like, hey, where do we really want to be? Do we want to be on the East Coast of the United States? Do we want to take a continental Europe perspective? Where do we want to be? Let's have our analysts begin to compile all the pest control companies in a particular area and try to suss out what one would be the right platform. And then, why I said earlier on in our discussion that entrepreneurs out there should watch what private equity firms do, not what they say, what they do. They love to buy businesses that are not shopped or they're not auctioned. And we're going to talk a little bit about that, meaning they don't want a competition on the front end, but they love competition on the back end. So you'll rarely ever see a private equity firm sell a business without doing a formal sell-side process and getting every single buyer and their brother to come in and bid on that asset. That's what they do on the back end. On the front end, they don't want that.
Wait, so you're telling me private equity firms don't wine and dine other private equity firms and get them to give them a sweetheart deal?
I did a presentation at the WorkRave conference this year, and I talked about that. And we were only able to release clips, and I think Dylan's in the process of trying to release a few clips. We had 2 private equity firms actually say, I don't want you guys to release that. And we can't release it because they were in it to a certain degree. And unless we cut them out of it, it gets really complicated. We want to have permission to release things. But they didn't want us to release it because I said that very same thing. I'm like, these guys want to send out emails and want to make phone calls to lawn care operators and pest control operators. They want to convince those guys that price is objective. It's not subjective. There's not a different price per different buyer. They want to be able to wine and dine them, buy the business on the cheap. But then when it's time for them to sell, there's no way they would do that. They would run a very formal process and they would rack up the price. So anyway, I was saying for entrepreneurs out there, it's important to watch what these guys do. And what they'll do is they will find some platform potential targets. They'll reach out. Everyone watching this has gotten an email that says, hey, Nick, I noticed your company, ABC Pest Control, is the coolest thing. And, it's a great company, great history, awesome reputation. Really love the opportunity to chat with you. Or you'll get an email from a buy-side broker that says, hey, I'll give you a free valuation. I've got a client that wants to buy you. By the way, the client pays my fees, and obviously there's no such thing as a free lunch. So when somebody else is paying the fees, you better start asking yourself questions. But everyone gets those emails, right? And so, but that's part of the process. And part of the thing that we did when I left investment banking and I went and worked for American Capital, which was the largest publicly traded buyout shop. It was acquired since then, but back in those days, it was the largest publicly traded buyout shop. And I was a private equity associate. So I was one of those dudes I wasn't reaching out to companies. I was the guy that would get on the plane once we reached out to a company, and I would sit down and I would try to convince the seller that, hey, our money is as good as anyone else's. We're going to treat you better than everyone else. I would use every private equity buzzword, the second bite of the apple, and we're patient capital. And you talk to enough private equity guys, they all tend to sound the same because it's very difficult to differentiate that business model. But that's what I did.
Yeah, we care about your people more than anyone else does.
Correct. Correct.
Yeah.
I had the whole list. They gave us, I remember back in those days, they basically gave us talking points. Here is what the seller of a business wants to hear. Boom, 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 boom. And then you would say all of those sorts of things. And what you would do is cross your fingers and hope that they wouldn't engage an M&A advisor or an investment bank, that they wouldn't talk to their friends about it because, hey, it's a private ordeal. Just keep it between you. you would hope that they wouldn't talk to any other potential acquirers, God forbid, because now that would potentially increase the purchase price that we would have to pay.
Yeah.
And of course, as you well know, Nick, you better than anyone, is that much of your return in any sort of asset is locked in based on the purchase price that you pay for that asset, right? I mean, especially when you're thinking about value investing, right? That's where you get your return, buying something under its intrinsic value, and that's what private equity firms try to do.
Value, absolutely. Absolutely. It's perfectly rational for them to do so. And you were in the seat doing it. If I was in that seat, I would be trying to do the same thing, get as low of a price as possible for companies that I'm acquiring, because that's going to be good for the folks that are paying my bills and paying the bills of the private equity firm, which are our investors, not necessarily the companies we're acquiring.
Yeah. And the seat that I'm in today is to tell everyone, do the exact opposite, because I see how much money was left on the table by sellers by not really thinking through and doing this the right way. And so, of course, that's my mission today, to make sure they do exactly the opposite.
Yeah, absolutely.
Nick, as we go through this investment process, there are some things that I think are important for people to understand from a technical perspective. And, how we operated at American Capital is very similar to how every private equity firm operates today. And I just want to talk a little bit about that. As I mentioned, my job was basically to go out and meet with sellers and to try to convince them to sell their business or partner with us at American Capital. And partnering with American Capital meant like, hey, we could potentially buy all of your business, but ideally we found ourselves in a position where we were we became controlling shareholders in a company. So for example, let's say that you own Nick's Pest Control and you're doing $20 million per year in revenue. And I would sit down with you and Nick and I'd say, hey, listen, we'll buy 80% of your business. You're going to roll 20% of that, Nick. And you're going to be able to take a ton of risk off the table today, which is true. You're going to be able to redeploy that capital into real estate and stocks and bonds and buy some toys. You're going to roll 20% of that equity, meaning you're going to be a partner with us. You're going to own 20% of this business going forward. We're going to bring a lot of things to the table that you don't have. We're going to bring a board. We've got an ecosystem here. You're going to be dealing with a bunch of other CEOs that have done a lot of cool stuff that you're going to learn from. We're going to blow that business up, Nick, so that 20% is worth, 5 years from now, is worth more than the 80% you're getting today. And so I would go out, I would make my pitch, I would attempt to get some financial information, we'd go through it, and we'd put together a financial model. Now, American Capital had a 2-stage investment process, very similar to almost every other private equity firm today. The first stage in the process was preparing what we called an IC Light memo, an investment committee light. It was kind of the Diet Coke version of an investment committee memo, which is maybe 10 or 15 pages. And we would explain our investment thesis in the industry, why we love pest control, growth rates, total addressable market, the fragmentation, how we're going to be able to acquire all these businesses, what it looks like today when we acquire this platform business, what our blended multiple will be over time, what sort of capital we're going to return to our GP and LPs 5 years from now by doing this great investment. And we'd have a nice financial model and we'd sit down with the investment committee and say, we need your authority and permission to make a bid or provide a proposal to the seller. They would look at it. It was a 10-minute call. Sure, write a non-binding indication of interest or letter of intent. So we would put together a proposal. The investment committee would rubber stamp whatever that price is, and I would hand it to you. And I would say, hey, Nick, you've got a $20 million pest control business. I want to buy 80% of it at an enterprise value of $50 million, for example. You would take a look at it. We would have some conversations, and my great hope working for the private equity firm was that you weren't going to push back much, ultimately sign that thing. We'd go to some dinners, we'd go to some sports games, I'd take you around, have a great time. You'd feel comfortable with me and my team, I'd feel comfortable with you. Next thing you know, you're not putting your business on the market, we're getting a deal done, we're partners, we make a lot of money together. That's the ideal world. And once we get to the point where, let's say that you looked at it and you said, okay, fine, this sounds great to me, I'll do it. You sign the letter of intent. Now I would do due diligence. And due diligence is a very important part of this process because I would not only do financial and accounting due diligence, I would do operational and industry due diligence, as well as legal DD. And we're going to do a whole segment on due diligence, so I'm not going to bog us down right now. But after I do due diligence, which is effectively making sure that I understand what it is I'm buying, that what I'm buying supports my investment thesis, that your financial statements are true, correct, and accurate, that you're not lying about anything, all those sorts of things. Then I would go back to my investment committee and I would have a 50-page report. And that 50-page report would have excerpts from an accounting firm's quality of earnings report. And I'd have an HR person opine on maybe your abilities as a manager. And I'd have like a criminal background check on you and your key team members. And then I would have the list goes on of all the outside advisors that you would bring into this and compile all these reports. And I would summarize all that, go to my investment committee, say, hey, Nick didn't fight with us. He didn't negotiate very hard. We had no competition. This is a great deal. And the investment committee would say, run to the bank, get that check, get this deal done. That's in a nutshell what the investment process looks like in every private equity firm that targets an industry. For example, you own a lawn care business or you own a landscaping company. If there's private equity firms that are going after you, typically they're going after 10, 20, 30, 50 other targets simultaneously. Nick, I wouldn't just go after your firm, Nick's Pest Control. I would find the geographic area I want to be in. I would go after Nick's Pest Control, and I'd go after 200 other guys like you. Because inevitably, there are going to be guys like you, Nick. It might not be you, although I hope it would be you. But there's going to be guys like you that are going to be like, hey, listen, if I want to sell this, I got one shot at this. And I am going to get a shit ton of money for this business. I'm going to hire an advisor. I'm going to run a formal process. I'm going to get 100 private equity firms in here, plus the strategics, and you guys are all going to be forced to bid against yourselves. Instead of taking $50 million, I want to take $100 million for my $20 million pest control business. That's it. But the good news for me is not all those guys are like you, Nick, and there are going to be some of those guys that'll effectively allow me to get away with it. And that actually puts me in a good position as a private equity investor to be able to do that. So that's the great hope. That's how the investment process works. What's your take on it?
Yeah, I mean, look, my take is very congruent with what you described. What I'm curious about is during that due diligence process, so once the LOI is signed by the private equity firm and the seller, how does that due diligence process differ if the seller is using an advisor like Potomac versus not?
You know, the DD process is going to be particularly different because number one, like, so for example, let's use your company again, Nick's Pest Control, right? You're selling that business. You've engaged us. We've gone out. We've run a full process. We've gotten a blockbuster number. You're excited to partner with these guys. Now it's DD time. Number one, we're going to put together an electronic data room. At the onset of the process, while we're preparing sell-side materials, we're going to assemble all sorts of documents and we're going to put together an electronic data room that's controlled. It's confidential. We control who gets in and out of it. We're able to see who checks documents in and out and so on and so forth. So we're going to organize the materials up front. And that's number one. Number two, we, as your advisor, are going to determine what goes in there. Now, the private equity firms can ask for anything they actually want, and they do, and they ask for way more than they need. We triage things and make sure we determine what it is they're going to see. We also make sure we determine what it is they're going to see and when. So at the onset of DD, before they've confirmed that they want to move forward at the stated price, on the stated terms, on the stated timeline, I'm not giving them access to your confidential client information. I don't want this private equity firm to be able to go out and look at all the sensitive data related to your customers, how you're pricing things and doing all those sorts of things. No, they can't see that. Now, at some point they have to, they're going to own the business, but they need to be able to see those things later in the process where there's much less likely a chance of the whole deal falling apart. 4, in addition to the sequencing and triage and timing and diligence materials, we've got an entire back office over here of transaction services folks. So the guys that are working for KPMG and PwC and Ernst & Young that are doing quality of earnings studies, I actually have gone out and poached those people from those very companies, and they work here. And so what we do is when we start a sell side process, we're already doing preliminary due diligence on our clients prior to ever going out in the market, because one of the most important things that you can do is make sure your numbers are right. And one of the worst things that could happen to you is, and this happens all the time, one of the biggest reasons deals either get repriced or blow up is the materials that the private equity firm or the strategic acquirer is basing their initial offer on, the one that you've negotiated and struck. Those numbers turn out to be very different in due diligence. And typical examples of this would be, you've got an owner who's he's gotten a $500,000 a year salary. He's also got $1 million a year draw, for example. And for some reason, the owner's accountant, who is a moron, has added the owner's draw back in as an add back, which has increased cash flow by $1 million, and that shouldn't be an add back because it doesn't hit the P&L to begin with. It's draw. It doesn't show up on the P&L. It's below the line. And I can't tell you how many times accountants will add this stuff back and overstate cash flow by $1 million. And when you're talking about deals that are getting inked at 10 to 20 times EBITDA, that's $10 to $20 million in value. And it's a very, very surprising day when the seller wakes up and the private equity firm says, hey, you overstated your cash flow by 750 grand, so I'm going to have to decrease your purchase price by 12 million bucks. Sorry.
So, and there's probably a litany of those types of items.
We could talk all afternoon about that. But the main thing is getting the seller in control of this, making sure that we time it out right, we conceal that which we don't want the private equity firms to see, or any buyer for that matter. And then quite frankly, 90% of DD is actually pushing around the outside advisors. There's a million calls that these advisors want to get on, and we try to mitigate the amount of time our clients and our clients' advisors need to get on this. It's an extremely time-consuming process. I've got 10 people here in our firm, that's all they do is DD. That's it. They just run the DD process. It takes a full team to do this. And unlike other M&A advisors and investment banks that typically don't have that. I mean, I think about in the industries that we're in, there's not a single other firm that has a DD department like we have. We're the only one uniquely in lawn and pest that actually does that.
Yeah, that's an incredible advantage.
Yeah.
And look, at the end of the day, a lot of the aspects of what you're talking about in the due diligence process are really giving buyers an excuse to change the terms, and most impactful, change the purchase price that they're paying through various due diligence tactics.
Correct. Absolutely. Before we get into structuring the deal, I think the next segment we're going to go into is the risks and the benefits of partnering with private equity. And I think we're going to have a lot to talk about there.
Yeah, absolutely. Because there certainly are benefits, but you have to be careful.
Absolutely. Until the next episode, Nick, thanks for joining me today.
All right, Paul. Thanks a lot. Looking forward to it.